Welcome to The Explainer. Today, we're going to break down the single most famous rule from, well, arguably the greatest investor of all time, Warren Buffett.
So here it is. Rule number 1, never lose money. It sounds so simple, almost obvious, right? But this isn't just some casual advice. This is the absolute cornerstone of his entire philosophy, a lesson he picked up from his mentor, the legendary Benjamin Graham.
And then, just in case you thought he was kidding, he hits you with rule number 2. Never forget rule number 1. It's classic Buffett. A little bit of wit, sure, but it's there to hammer home a deadly serious point about the paramount importance of protecting your capital. Okay, so what does never lose money actually mean? Because let's be real, nobody's right 100% of the time. It's not about being perfect. It's about understanding the brutal, unforgiving math behind what a loss really does to your money. Let's try a quick thought experiment. Say you have $1,000 and your investment drops by 50%. So now you have 500. The question is, what percentage gain do you need to get back to your original 1,000? Your first instinct might be, well, 50%, right? Well, no. The answer is actually a 100% gain. You have to double your money just to get back to where you started. And this is the harsh, asymmetrical reality of losses. Just look at this table. A small 10% loss? You only need an 11% gain to recover. Manageable. But as the losses get bigger, the climb back gets exponentially harder. A 75% loss requires a 300% gain. It's a ridiculously steep hill to climb. And here's why that math is so devastating. It's because losses are a wrecking ball to the magic of compounding. That dollar you lost, it isn't just a dollar. It's all the future growth that dollar could have created for you for years and years to come. Just gone, wiped out. Protecting your initial pile of capital is the only way to give it a chance to do its thing and grow. Okay, so we get it. Losing is bad, really bad. So how does the master himself actually put this into practice? What's the game plan for enforcing rule number 1? Well, it all comes down to a very clear defensive playbook. He lays out these core ideas in his owner's manual for Berkshire Hathaway. First, you got to think like a business partner, not a stock trader. You're buying a piece of a company. Second, he makes sure the managers have their own skin in the game, a huge chunk of their own money right alongside the shareholders. Third, and this is a big one, he uses debt very, very sparingly. And finally, he just sticks with what he understands. Simple, stable businesses. No complicated stuff. And his philosophy on debt, it's summed up perfectly by this quote he loves to use. It's from an Indianapolis 500 winner. To finish first, you must first finish. It's so simple. You can have the fastest car on the track, but if you push it too hard into a corner and crash, you're out of the race. He'd rather miss a little upside than risk a total wipeout that keeps him from even finishing. Now, to really enforce this kind of discipline, he suggests this brilliant mental model. Imagine when you start your investing career, you get a punch card, like the kind you get at a coffee shop. But this one only has 20 slots on it. And those 20 punches are all the investments you get to make for your entire life. Once you make a choice and punch a slot, that's it. It's gone forever. Can you imagine how that would change your decision-making? You wouldn't just jump on some hot tip. No way. You'd wait. You'd do your homework. You'd wait for an absolute no-brainer of an opportunity before you'd even think about using one of those precious punches. It's the ultimate defense against being careless. So all these ideas, thinking like a partner, avoiding debt, being incredibly patient, they're all tactics in the playbook, but they all stand on one single foundational concept. This is the key that makes the whole thing work. And it's called the margin of safety. This is another idea Buffett got from Ben Graham, and it's beautifully simple. Buy something for a lot less than what it's truly worth. That gap, that discount between the real value and the price you pay, that is your margin of safety. You can think of it like a buffer or a financial shock absorber. Because, look, nobody can predict the future. You're going to make mistakes in your analysis. Bad luck is going to happen. The margin of safety is that cushion that protects you when things inevitably don't go exactly as planned. Here's how it works in the real world. Let's say you calculate a company is worth $1 a share, but you wait and you manage to buy it for 75 cents. You've just built a 25-cent margin of safety right into your purchase. Now, even if you were wrong and the value drops 10%, you're still okay. You haven't lost money. Your protection was part of the price you paid. And that really brings us full circle. Never lose money isn't some impossible command to be perfect. It's the outcome of a disciplined process. It's the result of having a system built on patience, a partnership mindset, and most importantly, always demanding a margin of safety. It's a system designed so that you can be wrong and still not lose. So I'll leave you with this question, and it goes way beyond the stock market. Think about your next big decision, a career change, buying a house, anything. Ask yourself, what's my margin of safety? Where's my buffer for if things go wrong? Because building in that cushion isn't just about avoiding failure, it's about making sure you can stay in the game long enough to win.